very quickly for those few of my viewers that don't know sort of the Austrian take on inflation and perhaps the basic economic take on inflation. What causes inflation?
I mean, the basic overview would be that you have more money chasing the same or a slightly greater, more money chasing basically the same amount of goods and services. It's a monetary phenomenon. And over time, what begins to happen is as there are more dollars chasing more things, the purchasing power, which is to say demand, starts to drop. And at some point, it can reach blow off proportions in a galloping or even a hyperinflation. But I'm really cautious about even mentioning hyperinflation because hyperinflations are very rare, and you don't need a hyperinflation to destroy your economy. I wrote an article a couple of weeks ago about what was happening in the 99-cent pizza places in New York City and also other places where they're having to break the buck, so to speak. And you don't need hyperinflation to wreck an economy. A mere and very unsexy 10 to 20% a year will do the trick.
Yeah.
We talk a lot about those, but those are extreme situations that aren't necessary for upending economic interactions and social interactions related to money and all that.
And what's relevant about that, you mentioned Venezuela, and I remember, I think it was a few years ago now, Nicolas Maduro, the socialist dictator there, decreed a 500% increase in the minimum wage, which sounds kind of awesome on its face, because who wouldn't want a 500% raise?
Sure.
But of course, that was in the context of hyperinflation, and the people very much viewed it for what it was, which was a meaningless gift of money that couldn't buy any goods. There were no goods on the shelf, and even if you could afford them, the inflation rate was some X factor higher than 500%, and that happens even today in the United States. We're not talking about hyperinflation, but we're talking about sort of the slow stealing of particularly working folks who have savings accounts and hold a lot of their value in cash. When you print more money, the value of those holdings goes down, and unless you're a sophisticated Wall Street trader that knows how to play that game, you're getting screwed.
Yeah, absolutely. Not only that, but also there's a point where expectations take over, and someone like Maduro saying we're going to bump up, the minimum wage or whatever it is, leads to an accelerated drop in purchasing power as people are even less likely to hold money and want to immediately move that money into something tangible that they think they can either trade or will hold value or whatever. So at one point, it's like a treadmill that's going faster and faster. And you're right, it hurts people on a fixed income, it hurts the poor, and it also hurts creditors, because who wouldn't want to take a loan or receive credit and pay that person back in less valuable currency? So it's part of the dissertation I'm now working on has to do with the fact that when you have inflation, it also changes financial metrics. So the means that we use to say value certain goods or to look at balance sheets gets completely upended, and some companies that probably should be treated more harshly by the market may get by, and others that are doing a good job may not receive the sort of market credit they would in terms of like valuation price or in terms of transactions because of the various and sundry effects of the instability of the monetary unit.